This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
So I feel it's very defensive. And I've had people reach out recently because there's articles in the Wall Street Journal or Forbes about rents are starting to decline. And that may be happening on a macro level, but one of the markets was Phoenix, which we are partners in a few properties on. And the statistics show that Phoenix rents dropped 2%. But on our actual reports of the properties we own, rents are still up on renovated units 50% from original prior rent and 10% above the pro forma projections. So what we're seeing is you really need to do a deeper dive into the data, and some of the headlines in the news are not just not representative of what we're seeing in our specific niche.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. Given where we are today in the economic cycle, I'm sure people listening really want to know about distressed debt and where the market's going to be in the next 12 to 24 months and how to get in on that debt. Because understanding how to get on those deals and helping people unload those deals is absolutely key. Now, today's guest knows all about this. He started out as a real estate agent years ago, did fix and flips, wholesales, even did property management. Now, during the 2008 housing crisis, he joined Wall Street and started buying non-conforming mortgages. Then from there, he focused on distressed debt and spent the decade on residential non-performing mortgage market. Now, years ago, he merged that firm that he started with another PE firm that did over $3 billion in loan purchases. Now, he ended up taking down that knowledge and rolling it into his new venture, JKAM Investments, which is a select group of highly experienced real estate partnerships that specialize in multifamily, self-storage, and mobile home parks, as well as private lending too. They also do that. Now, investors can participate in these types of deals too in the JKAM Diversified Asset Fund, which makes direct placements into a variety of diverse projects around the country. Now, the firm actively targets strong risk-adjusted returns and off-market opportunities, providing institutional partners with really exclusive deals. Now, these alternative assets also offer investors a chance to earn passive, tax-advantaged returns and that are not correlated to the stock market. So, with all that, I'd like to welcome Jack Krupey to the show. Jack, thanks for coming on, bud.
Thanks for having me. It's great to be here.
You bet. Now, guys, if I get what Jack has to say, you can reach him via his page at jkaminvestments.com. We'll include a link in the description, okay? So, Jack, go ahead and tell listeners about your journey. It's very interesting how you went from doing fix and flips to now doing institutional grade type of investments. It's really cool to hear. So how'd you get started in all this?
Yeah, absolutely. And it's crazy because it's been over 20 years at this point. Time has really flown. So I graduated college in 2001. I have a degree in information technology, and I was fascinated with the internet and thought I was going to be this computer consultant or something. And then, right as I graduated, there were no jobs, and it was just a very challenging time during the dot-com bubble. And I went to Vegas for my 21st birthday and just saw the glitz and the glamour, and was kind of inspired. I was like, I need to do something to make more money and generate wealth if I want to do anything other than play $5 a hand blackjack with my hand shaking because I was scared. And I bought a book at the airport at Hudson News. It was one of those how to make $1 million in real estate paperback books, no money down stuff. I read it cover to cover and got back. I was still living in Rochester at the time. I'm from New Jersey, outside of New York City, but I did university at Rochester Institute of Technology. So I read the book cover to cover, and I was like, "Oh, this is so me." Just the personality types. I'm a natural networker. Everything I read about the book just inspired me, and I called my college landlord, And this is 2001, 2002. So this was the start of the prior real estate boom. And I'm a 21, 22-year-old kid. And within 3 weeks, I bought a house, almost no money down. Within another month, I bought another one. Within a year, I had 18 units. And I did have a job in the IT industry. It wasn't what I wanted, but it was still, it was something. And so I had a nice W-2. I was able to get mortgages back in 2002. If you could fog a mirror, you could get a mortgage. So I built up a number of properties and quit my job and went full-time in real estate. And, learned a lot of lessons, but also, had some great wins. I mean, we just started sending yellow postcards that say "We buy houses," and it took me a lot to spend the $700 to send that mailing out, and we made over six figures on that mailing. So, as I continue telling my story, the one piece of advice I just want to get out there quickly is, to take action, and that marketing works. Back then it was little yellow postcards. Now it's a lot more social media or text messaging campaigns. I get texts all the time from wholesalers and people trying to buy properties. So, had a great run in Rochester, but I wanted to get back down towards New York City. And when the market froze in 2007, 2008, there just wasn't as much going on up there. So I moved to New York, and fortunately, a lot of the private equity funds, they needed real estate people. A bunch of bankers were buying non-performing loans, and they needed people who had done the short sale from the investor side, who had bought REOs, who had fixed properties. So it was great timing, and I was literally working on Wall Street in December of 2008. And funny little anecdote, I lived at 37 Wall. I worked at 30. So my commute to the office was actually further vertically.
Huh. You actually lived on Wall Street?
I lived on Wall Street. Yeah, they're converting a lot of the old office buildings were converted to residential.
Yeah.
And it turned into a nice it's not the Upper East Side or one of the most exciting neighborhoods, but it's turned into a bit of a neighborhood down there in the financial district.
No, I remember. I used to live in New York. So yeah, it's I guess back then it would have been very different than what it is today. But yeah.
Yeah, absolutely. So I was at the firm in 08. This particular firm was buying non-performing second mortgages, home equity lines of credit for as low as 3 cents on the dollar. And, at the time, we didn't know if any of them would really be worth anything. But, the ones, a lot of them did reperform. And what ended up happening is so many of the first mortgages modified, then the people would come and modify their second mortgage. And eventually, there were people who made fortunes, especially on the loans in California, that they paid, 10 cents on the dollar for a second mortgage in California. And 5 years later, there's full equity coverage again. And either the borrower would refinance if they got paid off in full, or the loans would reperform and you could actually sell them back to banks. So, it was an industry where a lot of people thought we were vultures, but in a way, we were actually better than the banks because we were more flexible. We could look at the big picture and say, well, this person lost their job during the financial crisis, but now they have a new job. They can't afford to reinstate all of their payments, but they can make a new monthly payment and consistently going forward. So we did a lot of good. It helped a lot of people and reduced principal balance in many cases for loans that were underwater. And we grew the firm and partnered with a private equity fund that ended up partially acquiring us. And it was an amazing ride. I learned a ton, but I also, in many ways, created myself a job I sometimes hated. My life became looking at Excel spreadsheet pivot tables and, yelling at foreclosure attorneys and various vendors to move the process along. So, I got into real estate for this passive income and flexibility and lifestyle, and, ended up kind of in a New York grind. And also for the first time was paying a ton of money in taxes. When you're a real estate professional and you're flipping houses and you're, owning a number of properties, in general, you forget that, the taxes can take 50% of your income. And the way things were structured in New York, I was losing half of my money to taxes. So, fast forward a few years, I ended up leaving as an employee, but still owning a piece of the business. And I moved down to Puerto Rico, which has some interesting tax incentives, which, that could be a whole episode on its own. But, eventually I ended up getting bought out of the firm. So I had a significant capital event and I needed to, figure out, what I was going to do to invest my money. And I'd invested passively during these years in various multifamily syndication deals. just because I wasn't allowed to buy mortgages and I wanted some diversification. So I already had a good network of operating partners that I was working with, and many of them came to me and just said that when you need to raise, and you're an operator, so you know this, when you need to raise a few $1 million for a deal and you have 60 days to do it, there's always a need for programmatic investors that can be consistently co-investing into quality deals. And what I saw from the Wall Street side and a lot of my friends and investors, there's a lot of people who wanted to move some money outside of the traditional stock market, but it's really hard to get started. And if you're only going to start with a few $100,000, do you pick one deal in Cleveland or one deal in Dallas or one deal in Florida? Or, where do you find that diversification outside of, a REIT, which is not very tax efficient even though it's a tax structure, it's actually not very tax efficient for high net worth investors. So ultimately, I created the firm to provide access to these types of opportunities for, my tribe of investors. And I was never able to take capital in New York because we had pension funds and it was really institutional capital, but I wanted to open up the opportunity. And I do think that, a majority of accredited investors have too much of their net worth just in the stock market and in traditional financial products and not enough into the alternatives, which, at least from my experience, have vastly outperformed, even across a few cycles and crises. If you're well positioned in the right assets and with the right team, you should make a much higher return in the alternative asset sphere.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me. Absolutely. So right now, these days, now you're doing this fund-to-fund models, right? Just like you pointed out here a second ago, where now you're partnering up, so to speak, with other syndicators and other types of deals, I suppose, because you're doing the multifamily, you're doing the self-storage, you're doing that type of thing. So tell us a little bit about that. Tell us about the profile investor that's getting in on those deals today, and the types of deals that you're investing in.
Sure. So, we're a 506c, so we're open to any accredited investor. I tend to, or at least the people that tend to migrate to and find me, tend to be, two types. Number one is just hiring professionals that want to move some money outside of Wall Street and see our content and see what we're doing and want that diversification. Because if you're just going to take your first 50 or 100,000 into one deal, that's a lot of concentration risk. And they leverage our track record, our experience, our network of sponsors, that I have my own money invested in the fund into these deals as well. And the second is a more active investor, but I'd call it a tired landlord, or a landlord who's maybe transitioning more to a passive role, and that has a lot more to do with the tax incentives. Many of our deals, and I'll go into the types of deals we like in a minute, have a large amount of accelerated depreciation. So, if you're an investor and you own 20 properties free and clear, you've owned them for 15 years, 20 years, you've taken most of your depreciation already. You may be, having hundreds of thousands of dollars a year in rent coming in and not enough deductions anymore. Through majority of these multifamily deals, for every 100,000 you invest, it's not uncommon to get a $70,000 or $80,000 loss on paper through a K1 loss through accelerated depreciation. And that is significantly more tax efficient than any other investment that they can make. So those are two, and then we have various other types of investors, but those are the two that stand out to me. As far as deals, we really like value add, and tend to focus heavily on multifamily in the Class B space. Some people call it workforce housing. I've used the term middle class housing. But there's a drastic shortage of housing across the board, but especially in that workforce housing. These are properties you cannot build at the current cost without some type of tax incentive or grants or free government money. It just does not make sense to build this type of workforce housing. And I feel it's much more immune to, what's going on, potential recessions. If you're in the highest end Class A and there's a recession and you lose your job, those people are going to downsize into the more affordable Class B, and they want a nice place to live, but they'll forego some of the luxuries. So I feel it's very defensive. And I've had people reach out recently because there's articles in the Wall Street Journal or Forbes about rents are starting to decline. And that may be happening on a macro level, but one of the markets was Phoenix, which we are partners in a few properties on. And the statistics show that Phoenix rents dropped 2%. But on our actual reports of the properties we own, rents are still up on renovated units 50% from original prior rent and 10% above the pro forma projections. So what we're seeing is you really need to do a deeper dive into the data, and some of the headlines in the news are not just not representative of what we're seeing in our specific niche. So we love multifamily. Self-storage has historically been recession resistant. Mobile home parks, again, very similar to the Class B value add. I mean, they're a more affordable housing component. And then there's a few other interesting deals. We're in a few student housing deals. They tend to be in SEC country, Southeastern. I think we have one in Auburn, one in Gainesville. It was just an interesting deal with solid current cash flow. And we were in a few industrial deals, usually with some type of lease up. So value add is often thought of as just multifamily renovating units, but there's a number of ways to be creative and add value. That could be buying a property off a developer. So our one light industrial, a developer built it, got one anchor tenant for 60% of the space, and had another opportunity to build something else. So they sold that property for cheaper than it would have been if it was fully rented to the group that we're invested with, because they could take their money and get a higher return elsewhere. And they left some meat on the bone. And 6 months later, now this place is fully rented. We'll probably do a cash out refinance at some point. We're going to kind of wait on rates. Our current rate's not that bad, and we're going to wait and see what happens. Do we just sell it, or do we do a cash out refi and pull out some tax-free cash? So those are all great asset classes. We do like ground up if you can build, because you are building, assuming you're building below the market value and you have a built-in margin. But for us, the cash flow is a little more challenging, just because those deals don't spit off any current cash flow until it's built and stabilized. But we do like those opportunities when we can get into them.
Right. So what sort of deal size you're looking at then? We're looking to throw money at these things. So that's what I mean.
Yeah. So we like to be in larger institutional quality deals when possible. So for multifamily, it tends to be 100+ unit buildings because you could have on-site management. It also helps with the exit. And it's just also what I found is if you're doing you try to do a partnership on a 2-family with just like a friend or just like a local guy from a real estate club, those deals are a lot more likely to potentially have headaches or go sideways than a 100+ unit building. The barrier to entry, the level of financial sophistication, just the level of success you already need to have to get into those deals. A 100-unit building where Fannie Mae or Freddie Mac or HUD is going to loan, there's a net worth requirement. You need to be, at least one of the partners or the partners combined need to be worth enough money. I think they need a net worth of about what the loan amount is. They need liquidity. You need 10%. If you're going to get a $30 million loan from Fannie Mae, one of the general partners needs $3 million in a bank account or in a stock portfolio. And, just when you have that much skin in the game and that level of experience, I've tended to see that those deals, perform better. And at the stage in my life and career and our investors as well, we want to be in deals that have enough economy of scale, and that they're run by, experienced professionals. As far as our allocations, we're usually a piece of the raise. When you're raising $10 million, $20 million for a deal, most of these sponsors have half to 2/3 of the money from their own network. And then they're looking for, other aggregators to come in and write larger checks. So, we provide a lot of value to our investors because we give them diversification, but to our operating partners, if we're writing even $1 million check, that's 10 investors that they didn't have to, chase paperwork on, chase accreditation letters, have an hour phone call to pitch the deal. And, it's a very, very much a win-win. And, and for that, we typically are a minority co-GP, but we're typically, part of the GP. So it actually does not generally add a significant layer of fees to our investors as well, because we're getting better terms than they would if they put 50,000 directly into a deal.
I gotcha. So someone had, let's say, there's a 100-unit deal. Maybe it's not even ground up. Maybe it's an office conversion, $32 million. So you're able to bring, let's say, $1 million, right? I think, well, it really depends on the limits or whatever, how much you're comfortable putting into the deal. But let's say $1 million. So what happens is the LP puts in their $1 million, and then you guys get a piece of the GP as well. I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Now, economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items, meaning that dollar is losing value, and if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there. These webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show.
Exactly. That's generally how it works. Occasionally, there's just different share classes. So the only other way it works from time to time is they'll say any investor who comes in for over $1 million gets lower fees or a better profit split, say an 80-20 profit split instead of a 70-30. So sometimes we just do it through a fee break, but it's more common because we are, actively diligencing the deal, working with the partners. We're certainly not, a full, we don't need control necessarily. We're not looking for that, but, we are legitimately part of the team and functioning as part of the co-GP, and a big part of the co-GP is helping raising the capital. But, for certain SEC rules and stuff, there's ways to structure it where we're not just getting paid for raising capital because we're not a broker dealer. So we are, very collaborative, and then ongoing. I mean, we're not, day to day, the property management's happening with the sponsors, but, especially in this interest rate environment, we're actively, discussing the financial model and saying, hey, let's update projections. What's the forward curve look like? What sale price are we going to get based on net operating income? With the higher interest rate environment, with the higher exit, likely selling at a slightly higher cap rate, and just really, what's going to change with the business plan. One of the things we're seeing is we don't need to renovate as much. There are properties where we're getting the same rent that we projected without renovating, and that shows you that the market is still in most of our markets still strong, and there's a shortage of housing and there's a demand, and some of it's just inflation, but a lot of it is just the lack of that workforce housing product available in most markets.
Oh, absolutely. I think that when people make a blanket statement like rents are softening, well, it depends on where it is. It depends on to your point a second ago, when you're talking about how when you examine that deal in Phoenix and the rents are still the same, I'm like, well, yeah, because if you have a lease, an annual lease, and it's been at that higher rate for the last 6 months, why would it suddenly go lower? It's locked in, right? So conceivably, by the time the lease plays itself out, the rents can be back where they were before, if not even more, because I think that the rents these days are it's a whole ebb and flow type scenario, right? But I think the big part of one of the big takeaways here is that C-class workforce housing, in my opinion, those folks are under the greatest amount of pressure. Whenever there's an inflation like that we're seeing today, those people are the ones that experience the greatest amount of pressure. And housing takes the brunt of that pressure, right? So it's very, very tough for those people living in those assets and seeing their rents go up like that. I mean, that's kind of the reason why it's like, what we're looking to do is we're building more A-class these days. We're kicking around doing some Y-Tech stuff, but we're not quite sure yet. But these are the things that we're considering to try to make up for this housing crisis, because to your point, I really do believe that there's going to be a need for this type of housing on a go-forward basis. The question is, how do you find those properties? How do you find those distressed assets, so to speak? Because I think it's the only way it works is you have to, if we're doing like an office conversion, for instance, we know office is falling right now, right? And finding those assets, turning into a high-tech deal, doing all those sorts of things, great little effort and work that goes into those types of deals, right? So it's going to certainly be a very interesting time over the next 12 to 18 months, that's for sure.
Yeah, absolutely. Because I think most deals had 3-year interest rate caps, at least on the multi side. So, and really, a lot of people really dove heavily into the bridge loans in 2020, early 2021. Even when we were making our initial investments, we had a much higher percentage of our deals were still fixed rate Fannie Mae debt. And then by 2021, it seemed like the only way a deal would pencil was to go in with bridge debt. And when you do expect to do value add, you almost need bridge because you don't want to have a heavy prepayment penalty. So, we're in a number, we have over 40 plus allocations. So we're seeing across different markets how the financials are looking on deals, and, interest rates have doubled. There's deals where the debt service is doubled to the point where there's not significant distributions, because all of what was going to be that 5 to 10% cash on cash return for the investors is now being eaten up by interest rates. So I think there are going to be a number of sponsors that just get into trouble and eventually have to sell. And the ones that really are going to get in trouble are the ones that don't execute on their business plan of the renovation. Fortunately, a majority of the deals we see, rents are up, net operating income is up. And even if the cash flow in the short term is tight, the renovations, the growth overall in net operating income is going to surpass the renovations. But on the distress side, those that do get in trouble, how do we find the deals? I mean, it's you got to pound the pavement. It's a combination of broker relationships, because even off-market deals, usually there's some broker that has a pocket listing. Data, I mentioned earlier, us sending those postcards. And if you're looking for larger deals with like office building owners, I mean, you're not just going to send a yellow postcard. I mean, I know some people who send a FedEx or even send a video. There's, you might spend $100 for a mailing, but you could literally send them a little video that opens up and it plays for them. Tons of data services. I mean, you can go on CoStar and look at when people have balloon payments. There's certain lists that could be generated based on rules you set. And, it's really a lot of just networking and dialing for dollars and figuring out who's active in the market, who may be looking to sell, who may be looking just to recapitalize. Because we're not a day-to-day operator, we prefer to partner with best-in-class operators and not become an operator ourselves. But we expect there's going to be a lot of deals that this current ownership group may stay involved, but they're just going to need to refinance and probably pay down the mortgage to get a new loan at a lower loan to value. And for that, they'll need to be new capital. So I get excited about, and this is distressed, but it's not, it's a bad capital stack, not a bad asset. And if that is the case, I get very excited about coming in to recapitalize a deal and just kind of buy in. And then some of the investors, if the deal is struggling, may end up being diluted slightly if they don't want to put new capital in. But we can buy into a quality asset that we've already seen some of the track record on, and it's just the biggest problem is they got held back by bad timing in the market. So that's some of the simple ways that these are not heavy lifts of a deal. It's still just a deal that has hopefully good rent growth and just a bad loan. And we'll work through that. My prior history of buying out non-performing loans, I mean, we're certainly looking at those opportunities as well. I don't expect deep discounts because at 70 loan to value, most of these deals are not fully underwater, but lenders don't like to have loans on their books that aren't, paying clean, because the government the way the regulations are, they're basically penalized for like any loan that doesn't fit into that clean box. So they may sell the loan, even at par, but now we're buying it at a default rate. And then now we can negotiate with the ownership group. And if there's a property really underwater or, that's 50% occupied and it's real trouble, those will be opportunities. And, in your market with, things where there's construction, I think the more niche you get, the more opportunities you have for deeper discounts. But on the more institutional grade multifamily, I'm not expecting like fire sales from the banks, but I do expect some interesting opportunities to potentially, acquire the loan and modify or just restructure the properties overall.
Yeah, I think to your point, it's really having those relationships with those lenders. And because as careful as a lender may be when they're extending terms to a syndicator, to a buyer, sometimes bad deals are made. Happens all the time. I bought one of those distressed deals a long time ago, and turned out to be a great deal. The asset was fine. It was just a bad debt, and the guy was getting strangled out. He just couldn't deal with it. He put the wrong debt on the asset. Happens all the time. So now, do you have any preferred markets that you're jumping into with the fund here? Because honestly, I think we're going to see a lot of distressed stuff everywhere. Certainly, all the COVID stuff, all that did not really help the situation in certain markets when it comes to trying to cycle out some of the tenants that have decided not to pay any rent and any of that stuff. And certainly that's going to change out too. But what sort of markets are you looking at to really throw down and invest in?
So we tend to focus on the Southeast and the Sun Belt. That's not to say we're on a deal in Dayton, Ohio, not too far from you. But yeah, for the sake of, population growth, business friendly governments, we tended to focus on, and just markets that have, proven rent growth, job growth. So we're in a number of deals in Atlanta. We love Jacksonville. We've done 2 deals in Greenville, South Carolina, and then Texas. We're heavy in Houston. Peter Zeihan's an economist I follow. Peter just did a quick YouTube thing about Houston. I mean, it's the 5th largest city. There's all of the oil and gas, petrochemicals, and because of that, then there's manufacturing. There's all sorts of business growth there, and a shortage, certainly a shortage of workforce housing there. And then Phoenix and Vegas are markets we've invested in as well. And I'm still bullish on Phoenix, both markets. And then Vegas, surprisingly, there's a way less reliance on the hospitality industry in Vegas than most people think. I don't remember the exact stat, but I think it's only 30% or so of the jobs are just tied to hospitality. There's a lot more to Vegas than there used to be. And, overall, just the trends of, businesses and people moving from California to, a state with zero income tax. I think there's a lot of, good upside potential in Vegas as a market as well.
That's interesting, because back in 2008, Vegas really got slammed because the biggest part of the business was hospitality, right? I mean, so something clearly changed over there.
Yeah. I mean, it was also just such a bubble market where a lot of speculators were just buying the houses. So that was a big part of it. But yeah, there's a fair amount of growth. I mean, there's companies that are moving from California to Vegas. There's, similar to Texas. I mean, they were trying to recruit recruit businesses there. I have Howard Marks, Oak Tree Capital, who is very early in the buying of non-performing loans as well. He has a book about market cycles, and he's probably repeated it 10 times in the book. And I've repeated it on a few podcasts, so I'm quoting Howard Marks. His history may not repeat itself, but it does rhyme.
Yeah, that's right.
And so my first thought is Vegas is a boom and bust market, but it's probably not Vegas this time around. And residential housing, I think, is going to be somewhat sheltered. I think the commercial, the office building, you mentioned office building conversions, retail, that's the type of product that is going to be the most distressed. Single family housing, and this is something I think they'll see a headline on CNBC about, housing prices dropping. And then similarly, it's like the data, the devil's in the details for the data here. But 40% of homeowners actually don't have a mortgage, 30% locked below 4%. So I think ultimately there's going to be a supply constraint on the residential housing sector, and some markets probably should drop 5 or 10%. There's some of these markets were just COVID bubbles and just people moving out of California and New York to other places. So some markets maybe do need to decline a few percent, but overall, most of the people that bought those houses, they were not over leveraged into this terrible loan product that was going to go up in interest rate. They cashed out a lot of their equity from where they previously lived, either bought cash or got locked in a low rate and won't be forced to sell. So, there's always going to be job changes or life changes where people do sell. But in general, that person that, in 2008 might have walked away because they were underwater now has a fair amount of equity and a good long-term interest rate where they'll just stay for a couple more years, or they'll rent the place out if the numbers work, and and just move and rent somewhere else for the time being. So I think residential, that props up most of these other sectors. If residential housing remains unaffordable and the prices don't decline, there's a generation of renters who are going to rent longer. And just because it's going to be out of reach for affordability. I've seen the chart. It's about as unaffordable to own right now as it's been in the last 20 years or so.
Hey, I've been saying it in this show for the last 4 years. We're becoming a renter nation, and slowly but surely, the cost to buy a home has just become so cost prohibitive that renting is the only alternative. And if you got in early, to your point, when there's great time to buy with a 3% interest rate, you're not moving anytime soon. I think just they're going to end up sticking around in that property for a very, very, very long time, especially if they got a fixed rate over 30 years. They're not selling that thing. They're going to hang on to it forever. I mean, I would anyway.
Yeah. I mean, my primary residence condo here, I have a 2.88% rate.
You're not selling it.
And I'm in San Juan, Puerto Rico, a block from the beach. So I could rent this out. I would rent this out before I'd ever sell in almost any scenario I can think of. And I think a lot of people are in that same boat as well. And it's tough for the middle class. It's tough for those just getting out of school, trying to make it. But at the same time, it does give people more flexibility. More and more people are working online, remote work. I mean, just the whole ideal of you get out of school, you save, you buy a house, you live in that house for 30 years, you raise your kids. That's just, it's not the same dynamic anymore. So. Now it's, you move wherever for another job, test out another market, work remote, move to a different city just to see if you like it. I mean, there's a lot more flexibility with it, so it's not all negative. And fact is, like, parts of Europe have had a much lower percentage of home ownership. I think Germany, is about half the home ownership level that the U.S. had. So it's not unprecedented. It's sort of a unique American thing of sort of that, desire to own a property.
Well, it was part of the American dream, right? The American dream was defined as you and your 2.5 kids live in a home, white picket fence, you get 2 cars in the driveway, all that fun stuff. And it was a facade. It was a mirage. Didn't really exist, So that's a whole other discussion, though.
Yeah.
All right, good. Well, we covered a lot of stuff here today. So Jack, if someone's listening right now and they're kind of like, they're thinking about jumping into distressed, maybe they're thinking about maybe getting into office or maybe even creating a syndication of their own. what sort of bulletproof advice would you have to offer them?
It's really this, you got to take action in whatever way fits for you. So, it could be listening to this podcast is a good start, going to a live event. There's a lot of live events, whether it's multifamily, whether it's just passive investing. I know, I think, Best Ever Conference, I'm going to unfortunately miss it this year, but, I attend a number of industry events a year, and, you got to find your tribe, find your niche. And, there's a place in real estate investing for everyone. You don't have to be, this extroverted, gregarious, person like I tend to be. There's a lot of room for analytical people as well. And, every wild and crazy deal maker like me needs, somebody that could, handle the Excel spreadsheet and actually pull everything together as well. So, just got to dive in, and there's no substitute for meeting other people that are doing it. The whole infomercial thing back in the day, it's like, someone would see a Carlton Sheets infomercial, but like, yeah, no one actually does that. But, you show up, you don't have to travel either. Almost every city has a real estate club. If you're looking to get involved, you go to a local RIA, you're going to meet people that are actively doing things, taking action. And, often people need help, whether it's on the capital investing side or even on the diligence or, for dogging for potentially finding deals. So just gotta get involved and get started. Go from zero to step one, and you never know where life will take you.
Yeah, love it. Yeah, but hey, taking action that's where it all begins and where it all ends. You just sitting around thinking about it's not going to do anything. You have to really go after it. Absolutely, totally agree.
Absolutely.
All right, guys. Well, if you want to reach out to Jack, you reach him via his website at JKAMinvestments.com. Again, we'll include a link in the description. Hope you got some insight on distressed assets, on the opportunity that's there, and the opportunity to come with this changing market. Thanks for tuning in, guys. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.